Bankole Odusanya, the head of fixed income trading at UBA, now joins me from Lagos to discuss the story and more. Bankole, glad to have you join us on Closing Bell West Africa. I'd like to start by having your thoughts on Nigeria's debt sustainability at this time.
Okay. What has happened is that as part of the initial approval that was given by the legislature to borrow $29 billion, some of that amount has now been converted into local currency borrowing. This is simply because of what has happened to the ratings of the sovereign called Nigeria and the junk status of a possibility of issuing euro bonds. So it's wise that they convert some of that debt borrowing to local currency. So 850 billion will be coming in by way of local currency debt issuance from the DMO. We are, however, not sure whether this will be coming in by Nigerian Treasury bills, which is the short-term instrument, or whether they will be issuing them as FDN bonds from next month, or it will come also as CHEQUE bonds. The DMO, is capable of that will, could use any of those instruments to raise these funds. So, but basically, markets is aware of this information and pricing it in slightly, as we have seen slight inch up on Treasury bills bids.
So we've seen a number of policies, or we are continuing to see a number of policies coming from the Central Bank of Nigeria, some of them including lifting of temporary suspension on clearing of checks, latest moves by the CBN to kill FX speculations, talks about them debiting the banks to the tune of 1.47 trillion naira. I'd like you to paint us a picture of your thoughts on the CBN's latest interventions in Nigeria's fixed income and FX space.
Thank you very much. The central bank, in pursuit of stabilizing the currency and easing the pressure on the foreign currency, on naira versus the dollar, has continued to maintain a tightening stance using CRR and the LDR too. Last week, Thursday, there was a huge debit of 1.4 trillion, eating almost all the banks. But on Tuesday evening, or Tuesday, we received another refund, meaning that the central bank is very, very, very aware of system liquidity and is also concerned of what illiquidity could cause in the market. So, in as much as they debited on Thursday, in a few days they actually gave some credit. As to FX intervention, information just popped up right now that the central bank could be intervening today actually. There is a lot of demand in the I&E market, and the central bank is likely, from its fresh dollar raised from the IMF, they are likely to start selling. They could sell spot, meaning that the delivery will be on Friday, if sold today. They could actually sell in their forward market through the retail, selling between 60 to 90 days. But what matters the most is that they come back into that I&E market and through their retail intervention to start increasing the supply. The pressure you have seen of late is because of the skeletal activities at the central bank, where they've not been intervening so much. So we expect that this week and going into next week, and based on the fresh funds received, we believe that the central bank would intervene in the I&E and through the retail market.
And Bankole, how do you reckon players are processing the series of interventions that we are seeing from the Central Bank of Nigeria? Are interests going up, or are they feeling pressured?
Okay, what we are seeing there is divergent. Ordinarily, when money is being mopped up excessively, what you will expect is a sell-off by most participants in the market, and one of the largest stakeholders being the bank. But what you have also seen on the other hand is that over a long period of time, there's been shortage of supply of instruments because very limited participants are now allowed to go to the OMO. Most participants have to make do with FDN bonds, which is only sold once a month, or to buy Nigerian Treasury bills, whose yields are lower than 5%. So what is happening is that the banks continue to buy OMO bills The foreign portfolio investors, those who have not been able to buy FX for their exit purpose, have also continued to reinvest in OMO. So generally, the demand for securities continues to exceed the supply, despite the tightness and the tightening stance of the CBN. So that is what is happening. Despite the frequent mop-up we are seeing, in a huge sell-off, because there is already a scarcity in security issuance. That has been in place since September. Is the restriction of participants from buying OMO securities.
Bankole, you speak of demand peaking. Where are we seeing more interest, on the longer or shorter dated tenor?
Okay, on the Treasury bill side, we are seeing more activity and demand for bills between October and January. For the Nigerian Treasury bills whose yields are so low, most observers and investors in that line of security are looking at 90 days. This is simply because they expect that given the increased borrowing that we are seeing, the approval and a possibility of more of such increased borrowing on the local currency side coming in, you don't want to tie yourself for 1 year on the short-end Treasury bills. So most investors and surplus funds are trying to invest on the 90 bill end, such that by July and August, they will be able to reinvest at higher rates when the government is borrowing more or likely issuing more of these securities at higher rates. The deficit of the budget, the deficit of the 2020 budget was initially about 2.5 trillion. It has been revised to about 5 trillion. Meaning that the government will borrow more. We have seen them talk to World Bank, AFDB, and IMF. On the other hand, they are also likely to borrow more local currency. In view of this, most investors are playing short on the Nigerian Treasury bills, and we are seeing a lot of demand for October OMO bills also. It is expected that in the second half of the year, yields will rise, and you do not want to have been locked into long-term assets. You'll be able to earn your maturities and reinvest at better yield in the H2 of 2020.